muscle power, electricity multiplied, energy, computers multiplied, calculations, internet multiplied, connectivity.
But how this is different is that it actually multiplies intelligence. One had never thought that one can actually do it. Way back, when I joined college, for example, when I did computer science, and they said that, coding is, the most difficult of subjects that humans can actually do. And everyone, went, now, people go for it. But now coding has become so, mundane and easy and routine because people have now moved on from there to intelligence. So this is, of course, a promise. This holds huge promise for us, but at the same time, there are also risks. We in India stand at a unique vantage point to leverage AI. We have the most advanced public digital infrastructure, whether it is Aadhaar, the UPI, DigiLocker, ONDC. We are trying to build and improve and expand the unified lending interface, the account aggregator. These are all public goods on top of which the private sector can build
AI because it has the potential to do for financial judgment what UPI did for financial transactions. That is, make it instant, granular, and available to the last mile. AI, well deployed, can close existing gaps in financial inclusion faster than any preceding technological innovation. Deployed carelessly, it can at the same time entrench new forms of exclusion and instability at a pace that regulators and banks may struggle to keep up with. We in the Reserve Bank, we had set up a committee for responsible, and it has come up with a framework for responsible and ethical enablement of AI, which submitted its report last year, and it very clearly and very nicely puts forth this tension. Much has been mentioned about this tension, but I think even at the sake of repetition, it's important that I speak about it. First of all, as Mr. Sethi reminded me, I remain unambiguous, on AI, and the Reserve Bank sees it actually as a capability to be responsibly harnessed and not merely as a risk to be contained. There are many reasons why the Indian banks cannot afford to sit on the sidelines and watch. Beautiful quote given by you. In the end, we all need to work. Things will not, happen on their own. Because AI is, and you gave reasons, listed out 3 reasons, why and how AI can help us. Let me expand on some of them. First, it changes the economics of credit delivery fundamentally. Traditional underwriting relies on financial history, precisely the data that is thin or absent for new to credit borrowers, for the gig workers, for those unserved sections of our society because they do not have formal books. AI models on alternative data, which we have a lot now, cash flows, GST filings, utility, payment bills, digital platforms, they can all extend the frontier of bankable India considerably. Secondly, AI allows banks to serve customers better. Customer centricity, focus, experience, customer delight is what everyone is now looking at. And this has the scope to enable it, provided, as again mentioned by some of you, it is used to augment rather than merely to replace human judgment. A relationship manager assisted by an AI system
that presents the right product, the right risk flag, can serve higher number of customers more efficiently. Similarly, AI-assisted grievance redressal, personalized financial guidance, they can enhance service quality to customers. Third, and perhaps most important for a country of our size, AI has the potential to be profoundly inclusive technology. The word used was democratize in your presentation. Voice interfaces in Indian languages, they can simplify banking by removing the language barrier, for instance. Fourth, again mention was made, operational efficiency. There is scope, some figures were given in the presentation, 47 to 49% of the operational costs,
operational costs vis-a-vis income that needs to be reduced. And AI can certainly help us in this regard. Fifth, it is AI and AI alone that can beat AI-delivered frauds. Fraud today move at speeds of an API call. A rules-based fraud engine, however well designed, is perpetually one step behind the fraudsters who adapt more frequently. It is only AI and machine learning models which continuously learn from transaction patterns that can identify
anomalies in real time rather than after the loss has centralized. Well, this list is only illustrative. We do not offer it as a mandate. Every bank's playbook has to be its own. It has to be shaped by its customer base, its risk appetite, and its capacity to govern, which is important, what it deploys. But I would urge all the banks present over here in the next 2 days and going forward to deliberate on where they stand in this journey of AI adoption and what is it that they can do to accelerate its adoption. You will obviously need to invest in technology, IT infrastructure, talent, skilling, reskilling. You'll have to forge sustainable partnerships because you may not be able to do all of it on your own. And you'll have to build the right governance structures.
None of this will happen overnight, and none of this will happen by accident. It will require
A deliberate, board-driven strategy backed by sustained investment and most importantly, a strong intent rather than a series of disconnected projects. Let me turn to the next half of the playbook, the tension, what brings the tension, and there are a number of risks which have been mentioned. I'll only briefly remark on them.
One is the black box problem, the explainability issue, because everyone would like to know if his loan application is rejected, why it is rejected. The auditors would like to know, the customers would like to know, the regulators would like to know. And so this explainability is one risk that we need to take care of. The second risk is bias and exclusion. A model trained on historical lending data, if left unchecked, it will learn and perpetuate those biases. We need to be very careful about these risks. These biases could be related to geographies, certain occupations, certain communities. So we have to ensure that fairness in AI is not a compliance checkbox. It is a design requirement from day one. The third risk is concentration and herding. If a handful of financial models or a handful of technology vendors come to underpin credit and trading decisions across much of the banking system, an error or a bias can actually perpetuate throughout the banking system. The fourth risk, again very well known to you, is third-party risk, vendor dependence. While we do acknowledge, and I did mention that you will need to build partnerships because all banks, especially the small banks, may not be able to have their own large language models and AI. They'll have to depend on outside vendors, and this is perfectly understandable. But then we need to manage risks because governance cannot just stop at our outer walls. The fifth risk is data privacy and security. Compliance with the Digital Personal Data Protection Act is just the floor. We cannot remain satisfied just by complying with it. That should, in fact, we need to do much more. And the sixth risk is cyber and adversarial vulnerability. These AI themselves can attack you. There was a report, I think in July, one of the very leading AI firms over there, they used they gave the AI a prompt to check their systems. That was actually an offline system. I forget the name, and but it was able to collaborate over months, not over a few seconds or minutes or days. Over months, they were all these AI agents. They were able to collaborate and hack their own systems. You need to be very careful about it. And the seventh and the most important is, which is actually the underlying and the fundamental building block, is that there can be erosion of human judgment and accountability. No matter how sophisticated the model you may build, for a bank's decision, the ultimate responsibility has to lie with the bank and not with the vendor or with the algorithm. We cannot say that it is the model who decided it. That can never be an acceptable answer, whether to the bank, to the customer, or to the regulator. Meaningful human oversight, the ability to explain, to intervene, and where necessary, to override, must remain a design principle and not an afterthought. So what do we expect from all of you? We have already articulated it in our recommendations in the framework that we have laid out. It rests on a simple philosophy, which is that innovation and safety are not opposing goals. They are, in fact, complementary requirements of a durable financial system. We have deliberately chosen a principles-based, proportionate approach rather than a rigid and prescriptive one, because AI capability and risk will look very, very different for a large bank than for a small bank which is utilizing perhaps vendors off-the-shelf projects. That said, certain expectations will apply across the board. I'll urge all the institutions here to treat the following as immediate priorities rather than as distant compliances. One is to maintain a complete inventory. We should be knowing as to which are the models which are actually running in our bank. So please maintain a complete inventory of those models. Established a board-approved AI governance policy with clear accountability for outcomes and not merely for technology procurement. Build the capacity to explain AI-driven decisions that materially affect a customer, red team and stress test AI systems, and preserve meaningful human oversight at each and every point wherein AI's system error could cause material harm to a customer or have concerns for financial stability. We, in turn, are committed to engaging with the industry as this technology and its risks evolve through a willingness to learn alongside you rather than just legislate from a distance, and provide proportional, consultative, evidence-based, and agile regulation making and supervision. We also remain committed, and mention was made in the recommendations, of providing you a sandbox which has been there for some time now as a safe space for testing innovative use cases. We will continue to provide and further improve on common utilities that may be required for the banking industry as a whole, whether it is for things like fraud detection or prevention, like we have the Mule Hunter. We are now trying to put in place a digital payments intelligence platform. We'll continue to work alongside you to see as to how we can reap the benefits of AI while keeping the risks in mind. So let me conclude. We have much at stake. We need to further build on the very highly successful Jan Dhan Yojana. We have still a large underserved MSME credit market, which is estimated in tens of lakh of crore of rupees. A retail credit culture that is only now maturing. Customer service that can be vastly improved. Intermediation costs that can be further decreased. And digital fraud that need to be prevented and avoided. We need to leverage AI for this. The banks that will win in the AI era will not necessarily be the ones that adopt AI faster or the most. They will be the ones who adopt it with full understanding of what they are deploying, the clearest accountability for its outcomes, and Mr. Sethi mentioned about it, the strongest commitment to customers' trust that has always been and shall remain the true capital of Indian banking. The role of bank boards, the risk officers, the management, the technologists, and yes, of course, regulators like us is critical. We must all work together. We must work deliberately, and we must work with purpose and quickly. I look forward to this journey with you. I wish the conference much success. And then let me also wish all of you a very happy Independence Day in advance. Thank you. Jai Hind.
Thank you so much, sir, for your very inspiring and deeply insightful address, sir.
Ideas, strengthen collaboration, etc., etc. I congratulate FICCI and both FICCI and IBA for organizing this event. I'm grateful to you for giving me this opportunity to share my thoughts. I must thank also my previous speakers for making my task easier, because most of what I had to say, I think they have already covered it. So the message, I'm very happy, is very, very clear. The road, the roadmap, is the direction is clear. I think the roadmap is what you need to, over these 2 days, chart out. It's very timely that this conference is being organized. This is actually, the future. This is the AI holds to this decade what the 2010s held, what digitalization held for the 2010s, what liberalization held for the 1990s. And so it's very, very timely and apt that we are doing this conference over here. I also like the use of the word, playbook, because it's not really, only one project or one procurement of technology that you do. It's totally a different way of organizing things, doing business, doing banking. And so, and it requires really, a total change in mindset. It's a shift in how we evaluate risk, serve customers, price capital, organize institutions. Happy to know many of the banks are already doing it. Some of you are considering doing it. The only question now before us is whether you shape the AI journey or you let it shape you by default. Before I turn to the topic of this theme of this conference, AI, let me reconnect with some. I think if you were to ask me two important risks, I think Ruchin was quite spot on. One is uncertainties. I'll put it a little differently, though. One is, geopolitical uncertainties which we are facing, and it's not only, the West Asia crisis, but a lot of other uncertainties, including trade-related, trade tariff-related uncertainties. This is one. And the other is cyber risk. So because of interconnectedness, I think these two risks. But I must mention that the Indian economy and the Indian banking sector is very well positioned to meet these risks, meet these challenges. As mentioned, the banking sector is very robust, strong, CRAR of, I think, 17-18%. GNP is less than 2%, and NP is less than 0.5%. Healthy liquidity coverage ratios, good profitability, price to book also, increasing as was shown. The macroeconomic fundamentals of the Indian economy, again, are very strong, and some of you mentioned about, I think Anand mentioned in his remarks of how, the growth has been so resilient. Inflation is more or less under check, and all balance sheets are looking good. The external sector too is quite robust. We have good forex reserves, and I would say every kind of shock government and all stakeholders have actually, taken this as an opportunity, whether it was the Ukraine crisis or the COVID. I mean, what is amazing and what is important to keep in mind is that every crisis, we not only, meet them, but we come out of it much stronger. So while this shock may temper our growth for the short run, I think it's very good, for the long term, because of the various measures that now the government and other stakeholders are taking. You look at measures, for example, taken for diversification of our supply chains for energy, for fertilizers, and other critical elements. Look at how we are trying to reduce our energy intensity, use of ethanol, blending, EVs. So all of them give me the confidence that, even on the external sector, for example, the number of FTAs that the government has signed, that will again, strengthen number of measures for capital flows that the government has taken. So all these, I think, all these things bode very well for our Indian economy going forward to meet these risks and challenges.
Thank you, sir. May I request Ms. Kidwai? First, I'll come to